Hello there, folks. Welcome into today's video. It's a four videos up here for me to react to. First one up here is from Cam. The market has moved very far, very fast upside. Want to hear where her perspectives are on where this market's headed now at this point in time. Then we're going to react to this video, a little 1-minute video here. Investors to step out of cash in 2024. This should be an interesting subject. And we do also know there's $6 trillion+ right now in money market funds, which is a very intriguing time period we're going through right now. Okay. Then I want to react to this little video here. Microsoft, here's why Truist puts a $600 price target on Microsoft stock. It's $374 today, so that would be significant upside over this next few years. So I want to hear what they have to say in regards to that one. That should be interesting. And then last one up here is this little 1-minute clip. Price in a lot of rate cuts for 2024, says JP Morgan's chief investment officer. So I thought this would be an interesting one because, you know, I'm just not so convinced about that. Okay. So appreciate you guys joining me as always. Thanks so much for being here. Thank you for being subscribed to the channel. And let's go ahead and start jumping into this.
12. And Cameron, just watching the markets, 4 days in a row of gains now, and all four of the major averages at their highest levels for the last 52 weeks. You think that the market is starting to feel a little overbought here?
Yeah, if we look at measures like the RSI, clearly we're now in overbought territory. What's interesting is that we got there back in November, but we were able to digest that simply with time. So being overbought doesn't necessarily have to be a very negative thing, but it is important to note that we have moved very far, very fast to the upside. One of the things that we're watching very closely as we move into 24 is that if markets remain strong, we continue to drift higher, where does that leave us on things like positioning and sentiment? We're in areas where positioning is overweight but not extreme. Sentiment is optimistic but not yet extreme. But we are nearing those areas, and likely that could become a very important watch item for 2024.
Does it feel like there's a little bit of FOMO out there, a little bit of fear of missing out as you get to the end of the year?
Before she answers about FOMO here, so this is why I'm a little worried. I'm a little worried about kind of the first quarter of 2024. And the reason I'm a little worried about that, and at some point there's going to be some sort of major shakeup and drop there is like you said, you know, there's been a lot of strength in this market, obviously. We're kind of in a little bit of a Goldilocks time, and it just has that sort of feeling like there's going to be some people that want to take profits at the beginning of next year in some of these stocks that they've made a lot of money in, but they don't want to take profits right now because they don't want to pay taxes right now. Because you take profits right now, you need to pay tax in April. You wait till January, February to take your profits. Well, then we're talking. Then you wait well over a year to pay those taxes, right? So I think that's a factor at play that I don't think is getting talked about at all. To be honest, I think it should be talked about.
And things keep melting up.
Yeah, I think certainly. One of the things that this reminds us of actually is the beginning of 2018, where we did have, as you said, a melt up where you didn't really have any macro boogeymen to scare people out of markets, and people thought that they just had to get in. And that's where you see positioning chase into things, chase into areas that have been very strong this year. But then it comes to the point where...
And also, like I said, you know, I called this, 2 months ago. I said there's going to be, likely a big Santa Claus rally coming. And the reason being it's going to be a forced rally is because, let's be honest, Wall Streeters went into this year way underweight, and you got to play catch up to the indexes. How do you play catch up to the indexes? You buy a lot of the NASDAQ stocks, and look at how those stocks performed in November specifically as people positioned in for Santa Claus rally. Now we're kind of running on the fumes of that a little bit here in December.
To assess, to say, where does that positioning reflect versus where expectations are for earnings, where valuations stand. But again, that's likely more of a question for 2024 versus the last 2 weeks of this year.
So we have the PPI number coming out in less than an hour's time. You've also got Jay Powell speaking later today. What are you watching from those two events? What do you need to hear?
From PPI, it likely will be benign simply because of energy prices. They've continued to fall, and that's a very important part of PPI. But then when we look to Powell, we'll continue to probably get some pushback against the aggressive pricing of cuts into 2024 of over 100 basis points. When we think about the dot plot, it's likely that the dot plot median will only endorse about 50 basis points of cuts. But then it's a question of, will the market care? Powell has pushed back against this cuts pricing pricing just a few weeks ago, and the market shrugged that off and said, no, we think you're still going to be cutting a lot. So it'll be very interesting to see the market reaction, as Powell will likely strike a bit more of a hawkish tone than what is being priced in by bond markets.
You know, you said that the market you thought was overbought in November, but that we caught up with it in a matter of weeks. What happened to change to say, okay, in a few weeks, this all of a sudden makes sense?
Yeah, I mean, we got to that overbought state in about mid-November, but instead of having a big correction back to trend, we just sort of traded sideways. And so now as we've drifted higher again, we're back in that overbought state. Like I said, it can actually be a sign that people are clamoring to get into the market and that you have good momentum. Breadth is a lot better. However, again, we'll have to be very aware and cautious about where positioning will end up, where valuations end up, sentiment, all of that put together to say how much good news, how much soft landing nirvana is already priced in.
Yeah, I mean, because when I think of something growing into it, I think of earnings catching up with expectations, but you're talking about just sentiment catching up.
Yeah, and I think that's also a very good point, is that in this melt up that we're in and been having, is that you've actually seen earnings estimates get revised slightly lower. It's not low enough yet to sound off alarms to say that earnings are going in the opposite direction of the market, but that's another really important thing to watch in 2024. You have double-digit earnings growth priced in for 24 and 25. Does that create a high bar for earnings to jump over, just a surprise to the upside? And so watch earnings estimates mostly into 2025, because if those start to drift lower, that may be a key risk for the market.
All right, so hold your horses for just a moment. Hold your horses for just a moment, okay? So first off, what you brought up there about earnings into 24, into 25, 100%, yeah. I mean, if earnings expectations were to start to weaken, let's say at the end of 2024 and going into 2025, certainly that would be a pullback for the market at some point in time in the back half of 2024, right? It's just, that would logically make sense. However, we gotta obviously see what happens in this environment, right? We know likely 24 should be very good for corporate earnings, should be a very good year. I mean, when you just look out there, you know, industry by industry, it's hard for me to really find many industries that aren't going to have a much stronger corporate earnings year in 24 versus 25, right? Industry by industry. And so, you know, even like some of the housing space, even some of the real estate space, I mean, even they're going to have likely a better 24 than 23. And that's one of those industries you think, you know, if anything would get worse. And so, man, you know, yeah. Next one up here, investors to step out of cash in 2024. This should be interesting.
Half of next year. What are the reasons that underpin it?
So the main reason is that we don't think that the Fed has yet talked about how much deceleration of inflation has taken place. So the reasons, and to your point, and I know you speak about this a lot, are they good reasons or are they bad reasons? The bad reasons obviously is a severe exogenous shock to growth. We think it'll be for the good reasons. So inflation coming down, we're already seeing that. I know, Lisa, you said no one cared about the CPI data, but we did care. We looked at the fact that 6-month annualized CPI on the core is down to 2.9%. That's really good news for the Fed. And I think they'll begin to recalibrate. I think that's about 50 to 75 basis points lower for 2024. And they start doing that by perhaps the June meeting.
Gagi, you said 2023, yield of dreams.
I did.
What's 2024?
It continues to be a yield of dreams. I mean, this year, obviously, fixed income did not have the year, at least in the beginning, it didn't quite have the year that we had hoped. But by the end of the year, we started seeing those yields move lower. I think 2024 continues to be the year of income. It continues to be the year where bonds generate, especially high-quality bonds, generate that return for you. And I think the 2024 is also the year that investors step out of cash. I think that's what I'm most excited about. All of that hoarding in cash that we have seen, that $1 trillion that we have seen, I think this is the year that investors feel comfortable stepping out into both the equity and the fixed income market.
Okay, so let's be very clear. If you're expecting the Federal Reserve to cut rates in June, let's say for instance, right? Okay, what do you need to have happen for the Federal Reserve to cut rates in June? I'll tell you exactly what you need. You're going to need, in the springtime, you're going to need a month after month, 2% inflation. Not like 2.9%, 2.7%. You really need 2%. on all the inflation metrics. Very, very close to it. Or you need an economy that's showing a lot of weakness where the Fed says, you know what, we got to start cutting rates. You really need one of those two scenarios for the Fed to start cutting. How likely are either of those scenarios? Well, I'm not convinced the economy is going to necessarily show horrible numbers at the beginning of 2024, or the first quarter or two. If anything, there could be a reacceleration. I think earnings are going to be strong. Obviously, the markets perform very well. There could be a pullback that could shake people up. But ultimately, I'm not sure that the Fed's going to get any information that says, "Oh man, the economy is getting hit so bad, we've got to cut in June." And I'm also not convinced, although I don't think inflation is going to be a problem for us in 2024. That doesn't mean it's going to be at 2% the whole year, right? I'm not necessarily forecasting that we're going to be at 2% for all the inflationary metrics that the Fed wants to look at here. And so is the Fed going to cut when they're not even at 2% yet? When they got an economy that looks just fine and unemployment's under 4%? I don't know about that, right? And so these are the things you got to question. And this is, I just, keep talking about this again and again. I think people are a little too optimistic with some of these calls that the Fed's going to just be cutting rates like crazy, coming up here very soon. I mean, people are expecting March cuts, April cuts. And I'm like, are we going to be at 2% consistently month after month for the Fed to do that? Or are we going to have the economy be so bad that I don't see either of those being plausible at that particular time? Maybe toward the end of 2024, it's a different situation. Maybe then we're consistently knocking out 2% on the inflation. And we can talk about that, right? Microsoft, here's why Truist puts a $600 3-year price target on the stock. Ooh, man, that's some nice upside for a sleepy stock like Microsoft. That's a big move up.
This morning, Truist's Joel Fishbein. Joel, it's great to have you. Thanks for the time this morning. How do you get to 600?
It's pretty easy. As you know, Carl, the AI seems to be the only 2 letters in the alphabet that matter these days. And it feels like Microsoft's in the pole position here. We've done a proprietary survey of Microsoft customers. 80% of them plan to initiate, put AI applications in their products by 2024. Microsoft has $1.2 billion Office users right now, 1.2 billion Office users right now. So they're in the pole position here to leverage this AI. And when we were asking their customers, they said, listen, we don't have a problem with paying $20 per user a month, even $25 per user per month for AI. That's how big of an opportunity it is for Microsoft.
Do you think Copilot is aggressively priced given that survey?
I think it's appropriately priced. Actually, I went into the survey thinking that people were going to push back and say, "Listen, we'll pay $10 or $15 per user per month." But most of the people we polled, we polled hundreds of customers, and they said that they had no problem paying $25 a user a month. That's how much they're seeing in terms of opportunity and leverage by using Copilot and getting a return on their invested dollar there.
Wow.
Yeah, I'm curious about this poll, Joel, because at a time where, we're sort of wondering what's going on with IT budgets. Usually when the economy slows, companies pull back on that. But I guess AI is a bit of an exception. So what have you found in terms of demand for spending on Microsoft products from the enterprise community?
Surprisingly, 80% expect to...
Before we go further here, let's go ahead and let's pull up Mr. Softy's forward P metrics and things like that and expected growth rates here. Let's try to find out if Mr. Softy is a deal here, okay? Let's go ahead and take a peek. All right, so we're going to go over to the earnings tab here for expected earnings estimates. And what we're going to find is, so their fiscal year ends in a weird time. It ends in the summertime, unfortunately. So they're trading about 33 times this year's expected numbers and about 29 times next year's expected numbers. So a little rich, right? No doubt about that. But remember, you're paying for the safety of the business model. So you've got to pay a bigger premium, right? That's the bottom line. You've got to pay a premium for a safety of a business model. Like people keep using Microsoft, and they're not going to stop using Microsoft, right? So, for I don't know, at least the next 5-10 years. So you're paying for the safety of the business model, no different than you'd pay for the safety of a Coca-Cola business model or Pepsi or something like that, right? Then we're expected to have, the company is expected to have double-digit revenue growth. So obviously you're going to need to pay a premium for that as well. So if I look at Mr. Softy, it's pretty fairly valued. I can't call it overvalued. I can't necessarily call it undervalued. If we were trading at about a 20, a 22, times next year's numbers, then I might feel a little bit different. I would feel very different because of the revenue growth here plus the safety of the business model. But yeah, okay. So the bottom line is Microsoft a money maker? And the answer to that is probably. It probably is a money maker. It probably is an easy money maker. But that doesn't mean it has the most upside necessarily of any of the big tech stocks. There might be some others that have Meta, a little bigger upside.
More for Microsoft. We already thought that they'd be saturated in their installed base, spend more. Over 20% said they expect to spend 10% more than they currently spend. Now, if you think about it, Microsoft can make up anywhere between 4 and 5% of a company's total IT spend. So that actually says a lot that I understand that that IT is under pressure right now. I think Microsoft's going to come out this a winner, a large winner. And I think that people are going to really invest heavily in Microsoft and these Copilots. And, in our estimates, we only are really factoring in Copilot for Office. Microsoft's, launched 20 different Copilots in various products right now. So I think we're actually being fairly conservative in our assumptions of $6 billion in incremental AI revenue over the next couple of years.
So let's say we get a volatility spike up, and let's say, at some point in the first quarter, Microsoft stock sinks a bunch, right? Along with, a bunch of other big tech stocks. Is Microsoft a buy at that point in time? And the answer is yes. Yes, absolutely. Any major dips in a stock like Microsoft is a buy. It just kind of gets into, is that the best buy for your money, right? Because there might be better opportunities out there. But is it technically a buy? Yes. Any major dip in the stock is a buy.
Let's think back to Nadella telling, I think it was The Verge, we're going to make Google dance. To what degree how do their rivals keep pace?
It's interesting right now. Obviously, the Amazon came out with Q, and Google's got Bard, and they just don't have the enterprise footprint right now. I mean, I gave you some of the statistics in terms of Microsoft's footprint: 1.2 billion Office users right now. I mean, their footprint is so huge. Now, the other thing that we put in our report is, on a dollar basis, Azure is growing faster on a dollar basis than Amazon is or AWS is right now. So
from a much smaller base,
AWS, we don't cover it. It's covered by a colleague of ours. Is going to have some problems here keeping up with Microsoft because of the innovation, because of the partnerships with OpenAI, et cetera. So I think it's going to be interesting, and maybe that does finally drive some consolidation in the space if the regulators will allow it.
Yeah, so I've considered Microsoft, not just because it's one of those stocks that's a pretty easy buy the dip type stock. That's what I'm looking really forward to, by the way, pricing a lot of rate cuts for 2024. That should be interesting. But the other reason I've thought about buying Microsoft stock recently is I thought about it from the angle of, okay, Amazon stock is my third biggest position in the public account, okay? And I was thinking about it in terms of the only competitive threat really to AWS is Microsoft's cloud product, right? Azure. And so, or Azure, however people pronounce it. And so I was just thinking about, wow, if I own those two companies, I basically own the entire cloud, right? Those two companies are the premier players. Amazon's obviously the big dog, and then Microsoft is obviously the come-up company in the cloud market. And so I just thought, man, if I own both of them, I kind of am hedging my bets a little bit, right? And I'm kind of getting to prosper with both of them. And let's say, Microsoft Cloud outgrows AWS significantly over this next 5-10 years, which I don't necessarily see happening, but what if it does? Well, then I'm at least getting that upside there, right? And plus, obviously, all the other businesses for Microsoft. So, I was actually considering it from that angle there. But we'll see. But, is it possible I eventually buy some Mr. Softy shares? Sure. I mean, it's a good company, great balance sheet. I shouldn't call it a good company. I should call it a great company, great balance sheet. And it's at a fair valuation. Any major dips, it is a buy. Next one up here, price in a lot of rate cuts for 2024. Ooh, this should be interesting.
This year on this bond market, looking for this to rally. It has done over the last month. What do you think we're going back to right now, Bob?
I think you've got to start pricing in a lot of rate cuts next year. And the market is always tentative about changes in cycles, whether they're entering a hiking cycle or a cutting cycle. And the reality is, once they start cutting rates, they do a heck of a lot. We've looked over the last 40 plus years, the last 7 hiking cycles, and we've looked at the return of the bond market, the 2 years.
I mean, wait. You know, I sometimes, you know, I wish I was interviewing these guys, because right there I would say, okay, you're expecting a lot of rate cuts. So you're telling me the economy is going to get devastated in 2024 and the Fed's going to be forced to cut rates? And then he says, oh, yeah, okay, then it's fair. Or he says, no, not really. I say, okay, so you're expecting inflation to be 2% the entire year, in month after month after month, we're coming in with 2% on all the Fed's inflation metrics, so the Fed can say, okay, we defeated inflation, we're ready to cut. You know, you gotta push back there, because you know these people are just talking about rate cuts and a lot of rate cuts, and it's like, well, you need certain things to happen to get to that place, and if you don't see those things happening, you can't get to that place. That's where you got to push back right there.
Following the last rate hike, and bonds outperformed cash by 13%. And the average rate cut is about 500 basis points. And if you go to the couple periods where you didn't get that, the 95, 97 period, that sort of soft landing, you got 175 basis points in rate cuts. And if you go to the pandemic...
And here's another reason why the Fed might not be quick to cut rates, right? And why they're going to need to see 2% for a bit here, right? Is we know Powell is terrified of the 1970s. If they cut too early, the economy booms too fast, inflation spikes up too much, commodities market spikes up too much, guess what suddenly you have to deal with? Another hiking cycle, but into a much weaker economy at that point in time. You can't... No, okay, you do not want to have to do that, because then the economy would be at a much more weakened state than the first time you had to do that hiking cycle, right? So, you know, these are all things the Fed has to consider here, and that's why I'm just like, don't bank on the Fed making a lot of rate cuts in 2024. It's a possibility, but don't bank on that, man.
Rates had only gotten up to 2 3/8%, so you got 2 3/8% in rate cuts. That still averages to about 200. So once they start going, we expect a lot of rate cuts, and we expect excellent bond market performance going forward.
But when you say a lot, do you mean 200?
I think at a minimum. I
think that
they get down to the 2.5% to 3% range. Take zero off the table. Every conversation I have with clients, everyone wants to know, well, if they start cutting rates, does that bring us down to the zero lower bound? No, it doesn't. We're well beyond that. That was the last cycle, and hopefully that generational episode doesn't occur again for a few more generations. Something more reasonable is to take half of the rate hikes back. Think about 2.5%, 3%.
2024 is going to be fun, folks. Holy smokers, this is no joke. Some of these predictions I'm hearing, woo, boy, okay? Appreciate y'all joining me as always. Thanks so much for being here. Thank you for being subscribed. If you're looking to apply to join my private group, get access to all my courses, my 6- and 7-figure Discord chat, all that good stuff. Check out the pinned comment down there. You fill out an application. We can see if we can get you in there later this week or maybe next week, okay? Much love and have a great day.